Hey, it's Saylor, and this is episode 122 of the Orange Pill Investor. And I've been getting a lot of questions and comments since I finally reached a milestone of basically being work optional. My income on selling covered calls every week has eclipsed my 9 to 5 salary. And it's kind of funny, on YouTube there was a guy who actually called me a scammer and said he doesn't believe the premise, which I thought was hilarious. And I humored him a little bit and just responded like, I'm not really sure exactly what I would be scamming, since I don't actually sell anything. Like, I don't get any money. I mean, eventually, if I ever get enough, impressions or whatever on X, I suppose I could get monetized. And the same way on YouTube, but I would actually prefer that YouTube die in a fire. I'm still a little bit bitter about some of the censorship stuff that they engaged in during the virus that shall not be named. And but anyway, yeah, so there's a bunch of comments and questions, and so I thought I would put together a Q&A of a lot of those so I could get them all down in one place. All right, so question number one, what are the best stocks to buy when attempting to reach critical mass? Actually, critical mass is not a term that the people asking use. That's a term that I use to describe once you're able to buy 100 shares a week. So if you got a $10,000 account and you're getting 1% a week, you're going to be getting $100 a week. That's probably not enough to buy shares of a stock that's really worth trading. So you're going to need to grow this account. If you're collecting 1% a week and you really want to be able to buy another 100 shares a week, you're probably going to need like a $100,000 account. Now, that doesn't mean that you can't make a bunch of money here, because I didn't have that large of an account when I started. So on a small account, you're still going to be able to get the 1% a week. So you're going to be able to get the 52% returns a year. But once you reach critical mass, that jumps up to about 67% a year, because the formula for compound interest, if you're collecting 1% a week, but then you're getting 1% on top of 1%, which would the way you would be able to get that is you're buying an extra 100 shares and then you're selling an extra covered call. So let's say maybe this week you're selling 100 covered calls this week, and then the next week, since you're able to buy 100 more shares, you're selling 101 covered calls the next week, and then you're selling 102 covered calls the week after that, and then a week after that, and a week after that. So the formula for that, instead of just being 1% plus 1% times 52 weeks, which is 52%, the formula is now 1.01 raised to the 52nd power, because I do weekly expirations, so there's 52 in a year. So it's going to be 67% returns for the year. So that's what I mean by this. And my answer is that the cheapest stock that you can find that delivers solid premium is the fastest way to be able to get to 100 shares. So like Riot and Hut are around $10 a share right now. So that's going to cost you $1,000 a week. So if you're not getting $1,000 a week in premium, then you're probably not at critical mass yet. You're stuck with the pathetic 52% a week, or excuse me, 52% a year returns. And that's just returns on the premium. That doesn't even account for if the price of Riot, for example, is $10 now, and then a year from now it's $15. You're still going to be able to gain some of that upside. So, yeah. So for me, the cheapest are Riot and Hut, and the reason why I don't go for some of the other miners that are like, well, I think there's some that are like $3 a share, something like that. Trying to get 1% off of $3, that's $3 in premium. If the bid-ask spread, even if the bid-ask spread is very good, and there's a $3 ask and a $2 bid, you're probably going to have to go down to the $2 bid. So it's not even $3 a week. And then to close the trade on Friday, you'd have to pay another $1. So you're making like $1 a week. It's, to me, it's not really worth it on something that's under $500, or excuse me, $5 a share. So around 10 is probably good. You should be able to get 10, 15 bucks a week on those. And so getting kind of screwed on the bid-ask spread, getting into and out of the trade is not that bad. And the other one that I use is Mara, but that's about twice as expensive as Riot and Hut. And the other one I traded briefly was CLSK, which I immediately, I couldn't stand it because it trades in increments of a nickel. So if you're going to get paid, if you think you're going to get $20 in premium because the mid price is 18, and there's some bids at 15, there's some asks at 20, the mark price is 18, so you're like, oh, okay, I can get 18. But you actually can't put 18 into the price. You have to either choose 15 or 20. So you have to go, in order to get an immediate fill, you have to go to 15, which screws you out of $3 of your premium. And then at the end of the week, if you want to try to close it out on Friday, instead of letting it expire worthless, then you get screwed on another $5 a week. So CLSK was out. If you are going out to 45 days and maybe getting $1 something in premium, the nickel probably doesn't matter, so that's fine. But the answer to the question is, if it's too cheap, you can't find premium, but you can go out to 45 days. So I choose the miners that are around 10 bucks a share. And do I have advice for new option sellers? So I probably need to do a covered call and cash secured put strategy video out and just cover, like from a beginner's point of view. But I mean, everything that I know I learned from Tasty Trade videos and In the Money's YouTube videos. And so if I do it, I'll probably just be regurgitating the information that I've gotten from them. But maybe with the way that I do it and the way that I distill it, maybe I'll be able to put a unique spin on it. So if I think there's some value to that, I will probably do it. I've thought about doing something that's just maybe just like a marathon and just a giant, and I'll do the video, and that may be very long. But I kind of want to get it all down in writing as well for people that don't want to watch videos. I just get all of the essentials down in black and white as well. But in the meantime, the basics has been done on In the Money's channel, and he's also got an excellent covered calls video. He's got an excellent wheel video, and so I'll link some of these in the comments. And I've also considered about making a playlist, like a public playlist in YouTube of all of my favorite YouTube videos and creators. So I'll put something like that together, and then I'll share it. Here's the next question. Studies show that buy and hold gets the most of its gains on only a few trading days a year. What about limiting upside on those days? This is absolutely true. I went and looked at a couple of headlines, Morningstar and Forbes and other, and some were saying, 6 times a year gets all the gains, and another one was like 4 times a month gets all the gains. So I have no idea what the actual numbers are. I think Saylor himself said it's like 3 days a year that gets most of the gains, and if you miss those 3 days, you just miss the whole market. So it's the reason why some people say, look, don't try to time the market. It's a fool's errand, et cetera, et cetera. But this is exactly why I sell covered calls and limit my upside, because most of the time you're not even testing upside. So, I mean, if it's only 3 times a year, then 49 weeks a year, I'm not missing upside. I'm just creating value where there would have been none. But, let's say I'm being a little bit more generous than that, and 10% of the gains are made. 10% of the time, most of the gains are made. 90% of the time, the market's just down or barely up. That means on 52 weekly expirations, I'm going to, quote unquote, lose 5 or 6 times, and I'm going to win 46 or 47 times. And so let's just assume that on those 5 times a year, the stock goes up 20%, which would be kind of crazy. I can't imagine many stocks go up 20% 5 times a year. I mean, maybe. But I generally bake at least 10% upside into that call anyway. So I'm going to capture 10% of that 20%, and I'm only going to miss out on 50% of those gains, and I'm going to capture the other 50%. So you can say that, oh, I missed out on 50% upside, right? But I captured 1% premium 52 weeks a year, so that's, 52% is still up 2% compared to that. And that also doesn't include how many of the weeks are, do have some gains, like maybe it went up 1%, maybe it went up 2%, maybe it went up 3%. So anything under 10%, I capture 100% of the upside. And not only that, let's say that the price does go up 20%, or let's just say it doubles. Well, if I collect 1% the week after it doubles, now I'm getting 1% on a $20 stock instead of 1% on a $10 stock. So I kind of just don't care. I'm basically flipping this on its head and saying, instead of buying and holding the whole year just to get 3 good days or 3 good weeks, 5 good weeks, whatever, I'm going to take profits 45 weeks out of 52. And then, so I kind of just feel like I'm wasting less of my time. Now, granted, when MicroStrategy went from like $500 a share to $1,000 in a week, and then it went from like $1,000 to $2,000 the next week, I missed out on a shitload of that, and I actually had to pay up quite a hefty sum to not get my shares called away. So MicroStrategy might be the exception to this rule, which is why I've started trying to bake in like 20% call away value when I can. Now, last week I think I was only able to get just under 1% premium and 15% call away. So the MicroStrategy premium has actually died down a little bit too, which makes sense because implied volatility is a mean reverting statistic. So over time, the implied volatility will spike and then it will come back down to its kind of normal value, which takes options prices with it. But for me, and this is all hypothetical, like I don't know, it's 50%, 5 times a year, whatever. But whatever the number is, it kind of just all averages out for me. And in the long run, when I was tracking my gains versus the SPY, when I first started out, the SPY went up, after COVID, I think it went up like 80% in a year and a half, something like that. It was like you did well. Everybody did well right after COVID. But I think mine went up 200%, something like that. I basically tripled my account when the SPY was definitely not up more than double. So I was doing better than the SPY, that's for sure. And but then, so you're getting more, I'm getting more gains, but then what about taxes? So what are the tax implications of buying, versus buy and hold? And I'm not a tax professional, so I can't give advice, but as an anarchist and a libertarian, I don't believe anybody owes taxes. However, I still pay them because I don't want to get locked up. I don't need anyone knocking on my door, so I pay what they tell me I owe. And yes, I don't want them to take me to room 101, which is a 1984 reference. Check it out. So while the left and the right and everybody else is just arguing about, what percentage taxes we should pay, like what percentage wage slave we should be, I'll just be trying to make as much money as I can, and whatever, I log on to TurboTax, put all the numbers in, it spits out a number, that's what I say I owe, then I just pay it. And my rationale for that is, even if somebody says, oh, well, if you avoid the taxes until you're 65 and blah, 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 then you can get a lower tax bracket. I still don't understand that because I feel like I'm going to be in a higher tax bracket every year of my life. So I don't understand how people are saying, oh, when you're 65, you're going to be in a lower tax bracket. maybe that makes sense for someone who's going to have their 9-to-5 job and literally retire and stop working, and now like they're just going to take a little bit out at a time to live off of. Maybe that makes sense for them, but this is fun for me. I don't ever expect to stop selling covered calls in the market. I'm a bit of a gamer my whole life, and this is kind of like playing a video game. I'm always just trying to get high score, so I enjoy it. I enjoy trading it. I enjoy, watching the market. I don't even do technical analysis or, check fundamentals really hardly. Maybe I'll get into it, but I haven't really seen the value in it. I try not to spend any time on anything that's not providing value. And, so maybe if I think I can squeeze out a little bit of extra efficiency, then maybe I'll do that. But as far as I can tell, nobody ever turned down a raise from their job because they didn't want to be in a higher tax bracket and pay more taxes. Like, if you have to pay an extra 10% in taxes, but you're making an extra 50%, then, like, it's a no-brainer to me. So, but still, the criticism is a fair point. If you can pay long-term capital gains versus short-term capital gains, you'll end up with more money. So that's one reason why I kind of stopped doing the wheel, and I stopped letting my shares get called away. So if I can hold on to those shares, even if I have to pay to roll them, if I hold on to those shares for my basic understanding is that if I didn't let them get called away for at least a year, then I don't pay long-term capital gains, or excuse me, I don't pay short-term capital gains if I did let them get called away after holding them for a year. So still going to have to pay capital gains on all the premium, probably. But maybe that helps a tiny little bit. I don't know. I just try to make as much money as I can and then pay whatever they say I owe and keep myself out of handcuffs. So, also I did see a video that says that Puerto Rico, and then somebody mentioned, was it freaking Thailand or someplace? Anyway, there might be some Asian country you can move to that gets good tax treatment for stock market trades, but I don't know how viable their exchanges are, or can you just still trade? Can you still trade in the United States exchanges if you're a resident of freaking Thailand? I don't know. I don't know any of the answers to those questions, but this video claimed that Puerto Rico has very favorable capital gains treatment. So I was immediately like, yep, I'm moving there. But, got to convince the family. So we'll see. All right. Some people want to know, what about downside risk? What if a stock drops 50%? This is absolutely true. And I like to, no, not necessarily that I like to think this way, but I kind of feel like anything that is possible given an infinite amount of time is inevitable. So if it's possible, it's inevitable. And, drawdowns can and will happen, especially on some of the volatile stocks that I like to trade. Writing Tesla down from $400 a share down to $100 a share recently was extremely painful, but I believe in it long term, so it's going to continue to trade it. But I do often say that the down plan is the same as the up plan. So if my $10 stock drops down to $5, I'm still just going to collect 1% a week. And I kind of look at my account value or the share values as being X. And so if X is big, then I get 1% of a bigger number. If X is small, then I get 1% of a smaller number. It changes my strategy not at all. So if I buy in at $10 a share and it drops to $5, and I sell a covered call for $7, because that's the only place I can get premium at, am I risking losing $3 a share if my shares get called away at $7? Yes, absolutely. And a lot of people refuse to do that, and they won't sell any covered calls until they can sell it at their cost basis. So if they bought at 10, got paid $50, their cost basis is $9.50. They won't sell a covered call below $9.50. And so all of that time that they're not selling covered calls, that's called bag holding. You're just stuck holding your bags. You can't sell covered calls against them. You can't make 1% a week. You can't purchase additional shares with that premium. And so I don't do it. I don't bag hold at all, and I just pretend like I didn't lose anything. I just keep right on trucking as if the price is $5 a share, I just pretend I paid $5 a share for it. Now, that exposes me to losing money, and of course it does. But if you bought something like I did, I bought mining stocks at the all-time highs when Bitcoin is at all-time highs, and then they all crashed when Bitcoin dropped down to like 60 grand from like 72 or whatever the hell it was. And you can't unfuxer that mistake. You already made the mistake, so there's no way to fix it. Now you can just sit on your hands and hope that the market fixes it for you sooner than later, or you might have to hold a fucking long ass time though. You might have to hold it for a year to get it back to that level. And I'm not going to let the mistake that I made stop me from making money. I'm going to make I lost 50% of my portfolio. Okay, well, I'm going to get 1% of it back this week. And I'm going to get another 1% back the week after that, and the next, and then the next. If the stock rallies 20% and I only capture 10 of the 20, okay, I'd rather do that than just bag hold. But for the bag holders, if that works out for you, if that helps you sleep at night because you just can't stomach the thought of taking a loss, then do that. I don't give any financial advice, and you should absolutely do what you think you should do to be able to sleep good at night. And I've been doing this long enough that I just don't worry about it. Not that I don't care, but I don't care enough to let it bother me. And I kind of look at it as like, some traders will use a stop loss. So you buy in at $20 a share, you put in a stop loss at 18. If you thought the price was going to go from 20 to 30, but it goes down to 18, then maybe that invalidates your assumption. And so they will put in a stop loss, and they'll just be like, okay, I'm getting out at 18. I'm willing to lose $200, but I'm not willing to lose $1,000 if the price goes down to $10 or something. And I don't really do stop losses either, but I kind of look at it in the same way. So if I get screwed, I bought in, $20 a share, paid 100 shares, got paid $2,000, and the price drops to 10, and now it's only worth 1,000. Then I'm just gonna get whatever premium I can on 1,000. But the whole time, when I get 1% on the $10 shares, I'm still gonna get $10, which means I can buy another share. So now I'm buying the cheap stock. So my original cost basis was $20 a share, but every week I'm buying an additional share that cost me $10. So I'm dollar cost averaging my cost basis down, and I'm still collecting 1% on the smaller amount. So I'm continuing to dollar cost average my cost basis from that 20 lower and lower every week. So does it suck? Yes, it's going to happen. If you're a buy and hold, it happens to you too, but you just don't have the downside protection that I do. So it hurts, drawdowns hurt buy and hold worse than it hurts me. So I'm not going to let it stop me from collecting my 52% a year, or if you're at critical mass, my 67% a year, just because my overall account value of X has dropped in half. So the other things you can do if you're selling weeklies like myself, if the price does drop down and I can't really get good weekly premium, you can always just go to your cost basis and go out to 45 days to expiration. I never really go out past 60 because theta really starts to suck, and it's advantageous for the buyers, not the sellers like myself. So I will do that if I want to or need to. So that's an option. All right, what stock tickers do I like? So not only have I watched hundreds of hours, it might be thousands, of hours of options videos, at 2x speed. I can never really get past 2x. I would like to get to 2.5 or 3, but I find myself rewinding too much if I go above 2. But anyway, I've watched hundreds of hours of Michael Saylor videos as well. That's what turned me into a Bitcoin maxi from a degenerate shitcoin trader. And he said you buy an asset when it's disrupting and when it's the clear winner. So regarding disruption, he likes to say it's Apple. With the iPhone, they disrupted Nokia and BlackBerry, or Netflix disrupting Blockbuster. They dematerialized video and made it virtual. Or if you follow Tony Seba, which you absolutely should, he talks about the car disrupting the horse and buggy. And he's got some predictions for the future in, I don't know, like 6, 7, 8 different sectors of the economy. Of course, electric vehicles is one. The other one, I think they're going to be having yeast make proteins. So the bottom out of protein, like protein is one of the hardest requirements for poor people to satisfy. They're generally, especially meat proteins are fairly expensive. Well, I guess it depends. There's actually, you could argue that meat is so nutritious that you don't have to eat as much of it, and there's some cheaper options there as well. Anyway, this isn't a nutrition video, but the point is we're going to be able to have yeast just pumping out tons of proteins and creating kind of like fake milk and whatever. And so that'll be great for people who can't afford the actual natural sources, but it's also going to put price pressure on milk producers, livestock farmers, things like that. So lots of disruptions are coming. You should definitely watch everything that he puts out. So regarding the clear winner part, the way that I like to think about it is Tesla versus the competition that's supposedly coming, because they're not. But Facebook over MySpace, just because social media was dematerializing personal interactions like real life relationships, it doesn't mean that you should just invest in MySpace. Like, when Facebook stock doubled, you're not going to be like, oh, okay, well, Facebook is too expensive. Let me go sell half of my Facebook stock and buy MySpace. Like, MySpace went to shit. There's only room for one at the top. So you're gonna get on Facebook and you're gonna ride it for 10 years. You're not gonna be looking for investing in MySpace, which goes to zero. Same thing for Amazon and all the other online sellers. There's only one Amazon, and if you got on them 10 years ago, you probably did well. So you don't go looking for the next Tesla, the next Amazon. You don't have to egghead it and outsmart yourself. Like, Tesla's the next Tesla, and that's going to last for at least probably for maybe not my entire lifetime. Hopefully I'll last quite a bit longer, but at least for the next 10, 20 years. A monopoly is hard to dethrone. So maybe if you hold it for 20 years, it's time to diversify. But other than that, you just ride the winning hand. So the assets that fit those two descriptions for me, this is not financial advice ever, but the two that I picked are Bitcoin and Tesla. As far as the stock market is concerned, I can't really get option exposure on Bitcoin, so I have to look to derivatives. My favorite of which would be MicroStrategy, but that's cost prohibitive, so everyone can't get access to that one. It's a leveraged Bitcoin company, and they're creating a monopoly. If you want to know all the reasons, you should follow the Quant Bros on YouTube, at RyQuant and at Punter Jeff. Those two guys have some seriously bullish analysis on MicroStrategy. But if you can't afford them, like on my small account, I'll trade the miners like Mara, Riot, and Hut. I already said why I don't trade at CLSK anymore, because of the liquidity issues on the bid-ask spread. But Tesla's premium has been kind of trash lately. I haven't really been able to even get 1%. and very much call away value. But to me, they're the clear winner, and I can't imagine in the next 20 years when I wouldn't own Tesla. So I've even been adding some positions lately with Tesla, even though the premium's kind of crap. Tesla owns a bunch of Bitcoin, but I don't really consider them a Bitcoin derivative. They're not really a Bitcoin play because most of their value is from the cars that they sell. But the future upside is all about robotaxis and humanoid robots, their energy storage and all of that. So I think it's hilarious that people think it's just a car company. I used to be a premium hunter. I didn't care about the company's fundamentals. As long as the premium was good, I'd sell a put in it, covered call. Even GameStop, as shitty as a company as they were, when that short squeeze was going down, the premiums were insane. So I'm not even sure if I made or lost money on GameStop when it was happening. But anything that had high premium, I would just trade. A couple of times I was trading like which one of those car rental companies was going out of business, and I was like, oh wow, the premiums are really nice on this. And I was trading it for a couple of weeks, and then I was like, oh wait a minute, they have bankruptcy proceedings. So of course it's volatile, and as soon as I found that out, I quickly got out. So I'll trade anything back then I would trade anything as long as it wasn't in bankruptcy talks. But other than that, I didn't really check fundamentals or anything. I just do a quick internet search about whether they're going down the tubes or not. And as long as they were not going out of bankruptcy next week, I would just trade it. But that took me a lot of time. Market Chameleon is a great tool for options traders looking for implied volatility rankings. But I would spend hours a day just looking for new tickers. It's too time consuming, and it's just much more efficient for me now that since I have Bitcoin companies and Tesla that I believe in. Because even though some people say that selling covered calls is limiting your upside, it's still a bullish strategy. I mean, you still want to own things where the price goes up. You just don't want them to go up so fast that it outpaces the amount of money that you sold on your covered call. But yeah, I'm always cheering for my covered calls to go up, or excuse me, the price of the stocks that I own to go up. So I'm always long these tickers. So once I became a Bitcoin maxi, my philosophy kind of changed. I stopped trading anything and everything, and I finally had a couple of assets that I really believed in, and those are Bitcoin and Tesla. And Tesla's so compelling that I've still been adding positions even though the premium has been kind of weak. And so that means I'm not diversified at all. Like everything that I own is tech, and I would say probably 80 to 90% is Bitcoin, with like a 10%-ish Tesla position after that. And I'm including all of my MicroStrategy and mining stocks as Bitcoin derivatives. So I put those in the Bitcoin category. I'm okay with the risks. I've got emergency funds if I need to, especially with the dangers of trading in a margin account. In case of emergency, I can break some glass and pull out some extra money if I need to, up to and including my Bitcoin cold storage. I have actually done it. If the price on something gets too juicy and I want to own it, I'm not a strict cold card, once it goes in it never comes out kind of person. I may become that more once the yields you can get on your Bitcoin maybe go up, and the ways that in the future you should just be able to be like, hey, I got a bunch of Bitcoin, I'll rent it to you, or just collect a yield on it. But until that day happens, I mean, if I want to buy something and I can't afford it unless I open some Bitcoin, then I'm just going to crack it. So, You can come for my my Bitcoin Maxi card if you want to. That's fine. But I did it in MicroStrategy, for example. Sold some of my cold storage Bitcoin and picked up some more shares of MicroStrategy. Not all, but some. So whatever. How do you choose a strike price? I weigh two values. So I compare the premium paid and the callaway value. The premium paid, I kind of convert that as a percent of the current share price. And I will choose my strike to a lesser extent based on my cost basis. Like I said, I don't bag hold, but if it's close, maybe I'll just roll it up one strike or something so that I don't lose money and go below my cost basis. But the premium that I get paid is my guaranteed ROI for the week. So I'm balancing my guaranteed versus potential. So whatever strike I pick, if I go 10% above the strike price, then I can make 10% potentially if the price goes up 10%. But it's not guaranteed, and like we discussed earlier, most of the up days, there's only a handful of up days a week, so most of the time this doesn't even come into play. So I could be swayed by the argument that it might make sense to ignore this completely, except in MicroStrategy's case. When something can rip from 500 to 2,000 in 2 weeks, that is too valuable to ignore callaway value, in my opinion. Whatever you like, go for it. But so I will check to see what my guaranteed value I can get versus how much callaway I can build in, and I try to maximize both of those. And like MicroStrategy, I said those are kind of precious to me. I don't want them getting called away, so I'll bake 20% call away in for MicroStrategy, but maybe only 10% call away for the miners. When I was running the wheel, I would just sell at the money. Like if I don't own the shares, I kind of want to own them. So I would just sell at the money. I mean, sometimes you can get 5% ROI for that week. But if the price of the stock drops 25%, then you're going to be assigned way above the current price. And you can call that a loss if you want to, whatever. But generally, if you're selling covered calls, I'll just go to the 0.3 delta, and I'll slide it up or down based on how much premium I want versus how much potential upside I want to bake in. Can this work with ETFs? Yes, it can, but the volatility is generally less, so the premiums are going to be less. They're kind of, not very inspiring. IWM, I think, had a little bit better premiums than SPY and VU. But now that SPY and VU are, I think VU too, they have expiration dates every single day. So you can get like 250-something trades a year if you sold one every day. That would be a lot of maintenance. I mean, I guess you'd have to check the market at the open every morning. But I haven't run the numbers, but I think you could get like, 0.1% a day. And I think that still kind of works out better than buy and hold. But yeah, no promises there. But I also can't wait to see what the Bitcoin ETFs look like when they enable options. I'm not sure what in the hell's taken so long on getting us options for the ETFs. But I will absolutely trade these if the premium looks good. But for now, it's I prefer MicroStrategy. They don't charge a fee like SPY does, and the ETFs all charge fees as well. So I kind of prefer MicroStrategy and the miners to those, so I don't have to worry about any fees. How often are shares getting called away? Might have already talked about this one, but I think the deltas are fairly accurate, and even on Robinhood, like here we go. So if I go to view all options, I'm like, okay, what covered call do I want to sell next week? They're going to say, okay, at the money, it's about a 67% chance of profit. and where I sold at the $9, the 50, 84% chance of profit. Now these percentages are not exactly aligned with the delta, but they're just close enough to ballpark. So I think if you go to the 0.3 delta, then it's probably going to be about a 30% chance that your shares get called away. At the 0.2 delta, it's closer to a 20% chance, so 1 out of 5 times this will get called away. But if you don't want to lose your shares, then you can just pay to roll it, like I do. Or if you're running the wheel, you just let them get called away and you start over with a put. One person said, "Is this strategy?" They were saying, "Oh, you can get all this risk-free." I'm like, okay, no, there's no such thing as risk-free in the stock market. And another guy commented on my YouTube video. He's like, "Yeah, but you have downside risk. You should add in some risk-free trades." And I'm like, okay, can you give me an example of a risk-free trade? Because I'm not aware of what a risk-free trade is. I'm going to have to do some Google searching on risk-free trades. I would really love some of those. So not really sure what the hell the guy was talking about. But you basically have the same risk as buy and hold. It's just it's a tiny less risk than buy and hold because you're getting 1% premium. I mean, if you collected 5% premium, then your downside risk is 5% less than the buy and hold guys. Now, his upside potential is infinitely greater than yours, but, that's just how it works. So I kind of look at it as getting a discount on my stock every week. So whatever my cost basis is, every time I collect premium, it's 1% less. My cost basis keeps going down. If you can do that every week for 2 years, that's not likely because, like we said, eventually it's going to breach your strikes and you're going to have to pay to roll. But hypothetically speaking, if you collected 1% a week for 2 years, then you own the stocks outright for free. You basically paid nothing because you would have collected 1% for 100 weeks, which is 100% of the value. And whatever the value of those stocks would be, you paid nothing for them at that point. And it's just you're just playing with house money after that. So I'm not even claiming that this will always outperform buy and hold, but it's safer than buy and hold because it has that slight bit of downside protection in. So what are you trading away for that little bit of safety? You're trading away maximum upside. I don't keep this a secret, and it's one of the first criticisms that people have. They say you're picking up pennies in front of a steamroller, yada yada. But I'm reminded of a Thomas Sowell quote: "There are no solutions, there are only trade-offs." So I'm perfectly happy to trade away maximum upside for a higher chance of success, which is the way that I look at it. Every time I get a discount on my cost basis, that means I have a higher chance of success. There's a higher chance that in the future, the stock will be worth more than I paid for it if I'm constantly reducing my cost basis. And eventually I can just reduce my cost basis to 0. And then there's a 100% chance that it will be a successful trade. It may not outperform buy and hold. For the most part, I think I have also beaten buy and hold, but I wouldn't say that was absolutely the case all the time. Perfect example was MicroStrategy. For that 2-week period, I sure as hell did not beat buy and hold, but almost nobody else did either because their cost basis was $500 a share and it went to $2,000, and they didn't sell a damn thing. They rode that price all the way back down to $1,000. So all these people talking about, oh, you're sacrificing maximum upside. Well, guess what? You're probably too chicken shit to take advantage of maximum upside anyway. Because you're going to be like, oh, well, what if it goes from 2,000 to 3,000? And then it goes to 1,000. And then after it went down to 1,000, if your cost basis was 500, you're still not going to sell at 1,000 because now you're butthurt that you didn't sell at the top. So you're going to wait for it to go to 2,000 again. And then if you sell at 2,000, it's probably going to go to 3,000. And then you're going to be kicking yourself anyway. So all these people that say you're picking up pennies in front of a steamroller, probably aren't even picking up the whole maximum upside anyway, because they're watching it go all the way up and they're buy and hold, so they just hold until it goes all the way back down. So homie, don't play that, and that it works for me, and hopefully it'll work for you. But do your own research, not financial advice, all that BS. And I hope this Q&A was enjoyable, and I'll leave it there. Be good, y'all.